Right now, in a stretch of water just 21 miles wide, Iran is deciding which ships get to pass, and your money is on the line whether you own a single stock or not. Last week, a cargo ship ran aground in the Strait of Hormuz because Tehran withdrew the shipping lanes. The United States is striking Iran again. A fifth of the world's oil floats through that chokepoint. And the stock market's response: record highs. Wall Street calls that resilience. I call it a market walking blindfolded toward the one date that can break it, July 14. In the next 8 minutes, I'll show you why this war forces the Federal Reserve into a corner it hasn't faced since the 1970s, and the 4 signals that will tell you which way it breaks before the crowd figures it out. Here's the timeline in 60 seconds. The U.S. Iran conflict everyone declared over flared back up this week. Strikes resumed, and by Wednesday night both sides were hitting targets in and around the Strait of Hormuz. The president told reporters he wasn't sure if the war was fully back on. Read that again. The commander-in-chief said out loud, "I don't know." Markets wobbled for a day, oil pulled back, the Nasdaq jumped over 1%, and financial TV declared crisis averted. Buy the dip. But the smart money wasn't watching the headlines. It was watching the cargo. Shell just cut its gas production outlook, not because demand fell, but because Qatar's export volumes are getting squeezed by this conflict. Qatar shares the world's largest gas field with Iran, and every molecule of it exits through Hormuz. Oil and Treasury yields kept ticking higher even on the good days. Stocks trade the story. Bonds and energy trade the supply chain. And the supply chain says this isn't over. So why should you care about a shipping lane 7,000 miles away? Because roughly 20% of the world's oil and a massive share of liquefied natural gas squeezes through that 21-mile gap, and there is no pipeline workaround at scale. The moment insurers see missiles over that water, war risk premiums spike. Tanker rates jump, crude follows, and 6 to 8 weeks later it lands on you at the pump, in diesel, in freight, in fertilizer, in the price of everything that moves on a truck. Now the bulls have a point. Oil hasn't gone vertical. Every flare-up so far has faded, and traders have literally been described as immune to the pattern. But immunity is exactly how you get blindsided. The danger isn't a one-day oil spike. It's a slow, grinding floor under energy prices at the worst possible moment. Which brings us to the man with the worst job in Washington. Kevin Warsh, the new Fed chair, has already shown his cards. He's more hawkish than markets wanted. Inflation has stayed sticky all year, and now an energy shock is brewing on his watch. Some strategists are openly saying stocks at these levels are not pricing a rate hike in the second half of 2026. Not a cut, a hike. Look at the trap. If Warsh cuts while a Middle East war puts a bid under oil, he risks reigniting inflation that never actually made it back to 2%. That's the Arthur Burns mistake from the 1970s, the ghost that haunts every Fed chair. But if he hikes, he's tightening into a labor market that just cracked. June payrolls came in at 57,000 against expectations north of 100,000, and the previous 2 months were revised down. Hiring is stalling, and almost half of what's left is education and healthcare. Sticky inflation, weakening jobs, rising energy. There's a word for that cocktail, and it starts with stag. And the AI boom holding this market up. In the near term, those data centers and power buildouts are pure demand, inflationary today, disinflationary someday. So Warsh isn't choosing between hike and cut. He's choosing which mistake to make. And every week the strikes continue. Hormuz shrinks his room to maneuver. Now circle July 14 because 3 fuses hit one match on a single day. 1. June CPI drops in the morning. If energy pass-through shows up early, the hike conversation goes from fringe to mainstream in about 4 hours. 2. Warsh delivers his first real testimony to Congress as chair. If he so much as refuses to rule out a hike, watch the 2-year yield move. 3. J.P. Morgan, Goldman, Bank of America, Wells Fargo, and CD all report earnings that same day, and every CEO will be asked about the war, about credit, about the consumer. Live on the tape. Hot CPI, hawkish Warsh, cautious banks. That is the one scenario this market has not stress-tested. Record highs, semiconductors up 80% in 6 months, single names up 200, even 700% on the year. That's a market priced for perfection walking into a day with 3 separate ways to disappoint. I'm not a financial advisor and this isn't financial advice, it's how I'm reading the board. Here are the 4 signals I promised. First, tanker rates and war risk insurance premiums in the Gulf. Headlines lie. Freight rates don't. Second, the 2-year Treasury yield around Warsh's testimony. That's the market's live vote on hike odds. Third, energy stocks versus crude. If producers start outperforming while spot oil chops sideways, big money is quietly positioning for a supply shock. Fourth, breadth. Money is already rotating out of AI names into boring dividend payers. If that accelerates after Tuesday, it isn't healthy broadening. It's defense. Maybe the strikes fade, CPI comes in soft, Warsh plays it boring, and this becomes another wall of worry the market climbed. Genuinely possible. But the market shrugged it off is not analysis, it's a mood ring. A war on the world's most important oil chokepoint, a hawkish new Fed chair, inflation that won't die, a jobs market rolling over. That's not a shrug, that's a coiled spring. I'm covering the CPI print and the Warsh testimony the moment they drop on Tuesday. Subscribe and hit the bell so you get that breakdown the same day. And tell me in the comments, is the Fed's next move a hike or a cut? Lately this comment section has been sharper than half of Wall Street. See you Tuesday.